All right, so imagine waking up tomorrow to a massive global crisis. But here's the twist. It's not because we've run out of oil. Nope, the oil is still there, plenty of it. The real problem? We just can't get to it. This is the story of how one of the most critical arteries in the world's economy got clamped shut, basically overnight. And not by some old-school naval blockade, but by something way more modern.
And this quote right here, it absolutely nails the heart of the issue. This is the key to understanding the chaos that's just slammed the global economy. See, the market doesn't even need a real shortage to panic. All it needs is the fear, the doubt that the oil can't move. So it's not about missing barrels, it's about delayed barrels. And that delay, that uncertainty, that's what's causing all the panic.
Okay, so before we really dig into the economic fallout, we've got to understand the military spark that lit this whole fire. And believe me, this all went down incredibly fast.
I mean, the speed of this escalation was just stunning. It all kicked off on February 28th. A joint U.S.-Israeli strike targets Iran, killing its supreme leader. Literally within hours, the IRGC says, that's it, the Strait of Hormuz is closed. The very next day, boom, Iran starts launching missile and drone attacks on its neighbors, hitting the UAE and Saudi Arabia. And by March 2nd, we're talking just 72 hours later, the whole thing grinds to a halt. Commercial shipping just stops. Qatar Energy, a huge player, has to stop its LNG production. Think about that. A vital global artery completely paralyzed in just 3 days.
All right, so that begs the question, right? How can one tiny, narrow strip of water have the power to hold the entire global economy hostage? Well, to get that, you really have to wrap your head around the sheer volume of energy that squeezes through there every single day. Get this, 20%. 1/5 of all the petroleum the entire world consumes passes through that strait. We're talking about 20 million barrels of oil every day. To put that in perspective, that means 1 out of every 5 times you fill up your car, 1 out of every 5 flights in the air, its fuel is tied directly to this one little choke point.
And hey, it's not just oil, you know? It's also a massive route for natural gas. 20% of the world's entire LNG trade, mostly from Qatar, has to sail right through there. That's the stuff that heats homes, powers factories, a huge deal.
So where is all this stuff going? This number, 84%, is just staggering. That's how much of the crude oil from Hormuz is destined for Asia. We're talking about the energy security of massive economies. China, India, Japan, South Korea, all of them are intensely vulnerable and tied to this single waterway.
All right, this is where things get really interesting, because this crisis isn't what you might think. It's not a damaged oil field, it's not a pipeline blowing up. No, this is something totally different. This is what the experts are calling a movement shock.
So what does that mean, a movement shock? Well, put simply, the problem isn't that the barrels of oil don't exist. The problem is that the barrels are stuck. They're just sitting there in the Gulf, ready to go. But the supply chain, the highway that gets them to us, has been completely cut off. And this comparison makes it super clear. A production shock, that means the oil is physically gone, it doesn't exist anymore. But a movement shock, the oil is still there, you just can't get your hands on it. And you know what? For a global market that runs on just-in-time delivery, the immediate impact on prices can be every bit as bad.
And you can see it right here in the data. I mean, the numbers don't lie. In February, you had about 135 vessels a day going through Hormuz, normal traffic. Then, March 1st, that number craters to just 26. The next day, 23. We're talking about a collapse of over 80%. It's like a highway going from rush hour to completely empty basically overnight.
So you've got to be asking, how did this even happen? Iran didn't lay a single mine, there was no formal naval blockade, so what gives? Well, the answer isn't on the water, it's in the paperwork. It's in the invisible architecture of global trade, insurance. It was an incredibly fast chain reaction, like dominoes falling. Step 1, a few commercial ships get hit by projectiles. That immediately creates fear. Step 2, the insurers in London, the ones who cover these massive, expensive voyages, they see what's happening and immediately cancel all war risk coverage for the area. And then, step 3, no insurance, no shipping. It's that simple. No company's going to risk a billion-dollar tanker and its crew without coverage, so the entire global fleet just stopped.
And as you can imagine, a shutdown like this doesn't just stay in the Gulf. It immediately sends economic shrapnel flying all over the globe, and it hits different markets in very specific and very painful ways.
And this breakdown really shows you that the pain is not spread out evenly. For India, this is a critical threat. Why? Because 85% of their household cooking gas, LPG, comes through that strait.
For Europe, it's a massive headache for the aviation industry, cutting off 25 to 30% of their jet fuel supply. And for Asia, this is a systemic risk to their entire industrial economy.
This also helps explain why you might be seeing confusing headlines about the price of oil. There's not just one price. Brent crude, that's the global benchmark, it's for oil shipped by sea. So naturally, its price is going to spike when there's a shipping crisis. But then you have WTI, which is the US benchmark. It's more tied to domestic pipelines and storage, so it's a bit more insulated. And what we're seeing now is the price gap between these two getting wider and wider.
And just to double-click on that coin about Asia, this chart says it all. The crisis hits them harder than anyone. You've got these major economies, China, India, Japan, South Korea. All of them are now forced to scramble. They have to compete against each other for any available oil on the spot market, which, of course, just pushes the price up even more for everyone.
Meanwhile, Europe is in a really tough spot. After working so hard to get off Russian gas, they became super reliant on the global LNG market. But now, with their own gas storage levels lower than usual, they're stuck in a bidding war with a desperate Asia for those exact same LNG shipments. And this could easily reignite the kind of energy price crisis we saw back in 2022.
Okay, so this whole thing is unfolding in real time. How do you cut through all the noise, all the talking heads, and figure out what's really happening?
Here's the key. You need to watch the operational signals, not the political chatter. These are the things that tell you the real story. Are ships actually moving? You can track that. What are insurance premiums doing? That tells you what the money people really think the risk is. Are shipping companies adding emergency fees? Is that Brent WTI spread getting wider? These are the real-time, hard data points that'll tell you if things are getting better or worse, way more than any news headline.
Ultimately, what's happened in the last few days is a huge flashing red light. It's a stark reminder of just how fragile our system is, how one single choke point, one military flare-up, could put the entire global economy at risk. And it really forces us to ask a much bigger, more fundamental question. Is our deep